Good afternoon, ladies and gentlemen. As part of our CFO-centric webinar series, it is a pleasure welcoming you all to another webinar, The Future of Financial Reporting, More Rigor and Discipline. Today's deliberations will revolve around the enhanced regulatory environment and closer scrutiny by regulators, auditors, and other stakeholders on financial reporting aspects. The CFOs and finance leaders are required to prepare themselves as well as their teams to be able to understand and meet the apparent but not yet visible reporting norms. The panelists will deliberate on the above and will also share their practical experiences. Before we begin, I would like to give a brief about ASA and our speakers today. ASA is a 3-decade-old accounting and consulting firm with a team of over 1,000 professionals spread across 8 offices in India, besides a well-oiled network of national and international affiliations. We work with our clients, many from overseas, to help them set up offices and factories in India, find partners, take care of their audit, taxation, accounting, and business support requirements, and the GST advisory and risk advisory services, and also help them with restructuring and liquidations as well. Our esteemed speakers for today are Mr. Subba Rao, who is a chartered accountant and will be our moderator for this session. Mr. Rao is currently an independent director on the boards of GMR Infrastructure, Delhi Airport, Hyderabad Airport, GMR Airports, and Duty Free Services. He also chairs the audit committees of all these 5 companies, besides being on various board committees, either as a member or a chairman. He has just taken over as the chairman of a not-for-profit hospital, Samatwam, whose chief patron is former Supreme Court Chief Justice Shri Venkat Chalaya. In his executive career spanning over 35 years, he was associated with the GMR Group, RPG Group, Kotak Mahindra, China Light and Power, and Senmar Group in various capacities, including as the group CFO. We then have Rajiv Newar, who is the group CFO of RK Swami Hansa Group. Rajiv is a chartered accountant and a company secretary with over 31 years of experience, having held various leadership roles in finance and management, and led various initiatives with leading business houses such as Tata, largely with the Taj Hotels, Birlas, K. Raheja Corp, and Damak Groups. He has completed various programs, including the Tata Sustainability Leadership Program, the Taj Group of Hotels Challenges of Strategic Leadership, and the Indian School of Business Executive Program. He also attended the Cornell University Summer Program and received a gold certification in the Business Excellence Leadership Program. Then we have Kalisman Arunachalan, the Group CFO and Head of Strategy, Crompton Greaves Consumer Electrics Limited. Kalisman is a chartered accountant with a career spanning close to 2 decades. He has extensive experience in corporate finance, financial planning and analysis, business partnering, investor relations, fundraising, treasury management, strategic planning, audit, and risk management. His previous experiences include critical roles with Eicher Motors, Future Lifestyle Fashions, Models International, and in his earlier career, he's also worked with Aditya Birla Fashions and TVS Motor Company. Our next panelist is Dr. Anand Banka, who is a director of a global bank. Anand is a chartered accountant with a PhD in finance and author of 9 best-selling books and a celebrated faculty for courses on IFRS and Ind AS. He has been a guest lecturer and a speaker at various professional forums across India, US, UAE, and other countries. He is a special invitee on the Accounting Standards Board of the ICI, a technical reviewer for the FRRB of the ICI, and for the ICI International Research Awards. He is currently heading the technical accounting desk in India for a global bank. He has been presented a Silver Shield by the ICI International Awards to 2021 for his research paper in the accounting category. And he has also been awarded the Young Achiever Award 2020 by the prestigious Indian Achievers Forum. Under his aegis, Vedanta Limited recently won the Silver Shield in the ICI Awards for Excellence in Financial Reporting 2021-22. Finally, we have Sunil Bhumralkar, Independent Director of ASA. Sunil is a very experienced chartered accountant with over 37 years of experience working with leading professional firms in assurance services, including 24 years as a senior audit partner at SR Bartley Boy. He has extensive experience in financial reporting under Indian GAAP, Ind AS and IFRS, and on various aspects of corporate governance, risk management, and internal financial controls. During his career, Sunil has participated and led audits of large listed MNCs and Indian conglomerates. Sunil was also a co-opted member of the Auditing and Assurance Standards Board of the ICI during 14-15, a member of the Financial Reporting and Review Group, Bangalore, for the last 6 years, and is an active speaker at various forums. Before we begin with this engaging session, a few pointers for this webinar. Please note that all the participants will be in a listen to only mode throughout the webinar. If you have any questions or comments, please feel free to put them in the question section in the chat box. Thank you, everyone, and over to you, Mr. Rao.
Thank you. Thank you, Vikram. So good afternoon, everyone. So welcome to this webinar on future of financial reporting. So before we get into the discussion on the topic of the future of the financial reporting, I would just give a brief of what is the theme of today's session. Over the years, the CFO's role has been discussed, debated to the bone. However, one particular aspect has not received the deserving attention. So that is CFO's own governance. While CFO is the custodian of the board governance, committee's governance in a way, because the management assigns responsibility to the CFO, his own governance, he himself is responsible. And that is what we are going to understand. What is this concept of CFO governance? So CFO is governed by various legislations today. And one of the dimensions of his responsibilities is the external financial reporting. And in this critical job of external financial reporting, he has to deal with various legislations, right from the accounting conventions to Companies Act to LODR regulations, other SEBI aspects, and plethora of legislations. So this is where he has to focus on his own governance. He has to be constantly vigilant on what is the evolving scenario in these legislations to be effectively functioning and to effectively govern himself. So this is the topic of the discussion today. Unlike in the past, there are snooping agencies also today to investigate his role, to investigate what he is speaking outside, to investigate what he publishes. And these snooping agencies, particularly NEFRA, FRRB, so these are the agencies that we have, so that he has to take care in the current evolving scenario. We will delve into the topic now. In today's webinar, we will just explore this particular aspect of the external financial reporting and the various legislations surrounding this and associated aspects of the external financial reporting, including the internal financial reporting, because there is a dimension of the financial reporting that he has to work on. So we will get into the questions now. So first, I would just go to Sunil and Anand. The first question to both of them, or I would rather start with Sunil. Sunil, you have seen the evolution of the CFO profession over 3.5 decades or 4 decades in your audit profession. You have seen generations of CFOs. And how is it different now in the current scenario as compared to the past? Is the CFO role under threat now because of various legislations? So in my days, I did not go through so many legislations as we are going through currently. So I want your perspective as to how the CFO's role has changed in terms of his own governance, the threats that he is facing, and if you can explain this, if you can enlighten the participants, would be grateful.
So Subhara, thank you very much, and thank you. First of all, thank you ASA for giving me an opportunity to be a panelist with all the esteemed panel members. I think financial reporting is one of the most critical components, in the internally as well as externally, in terms of providing information, the quality information for the business and the financial decision making. And I think the quality reporting, the quality in the financial reporting actually gives a significant comfort to every stakeholder who is associated with the company and not just the investors and the creditors and the potential investors, etc. And I think what we have seen is that we have also seen examples that while I think somebody may have thought that in terms of taking some shortcuts, you could have some short-term gains. But what has also been observed is that low quality financial reporting has significantly eroded the brand value of the companies, and we have also seen number of financial scandals globally as well as in India. And if you take all these things into consideration, and the fact that society at large is now looking at this very closely because there is an increasing realization that the businesses are actually exploiting the natural resources of the society, and then obviously they are also answerable to the stakeholders at large, including the public. And as you can see that there is a significant now change with the way the all the stakeholders are looking at companies restricted to the financial performance, but what is their contribution to the society? What is their contribution to the environmental aspects? What is their contribution to the governance? The other aspect I think which is there is that the investors have also increasingly realized that they need to build they are also building a portfolio which is a sustainable portfolio. And if I see, I think from my perspective, I think over a period of time, just the expectations from the CFO in terms of the quality and the rigor of financial reporting has undergone a significant change. And now I think, the CFO's role is not, if I were to go back in the past, is not just looking at the accounting aspect, but the whole strategic aspects around, the business decision making, putting the whole governance structure or governance framework within the company along with the CEO. So he has become a very important, member of the senior management. In fact, I would say that rather the second most important other than the CEO. The CFO's role has also undergone a significant change vis-a-vis their responsibilities to the audit committee. Because audit committees themselves are under pressure to, and they are answerable, especially the independent directors, to the minority shareholders in terms of the company's risk management processes, internal governance mechanism, reporting requirements, etc., etc. And CFO again plays a significant role, to ensure that audit committee and the independent directors get that kind of a comfort. And the third very important role which the CFO has to play is to ensure that there is a very robust coordination with the auditors, okay, to ensure that all these three critical elements, the CFO, the auditors, and the audit committee ensure ensure a significant rigor around the quality in the financial reporting. So I think so to that extent, I think the role has significantly changed. And if I see now what the NFRA is doing, which is a new regulatory body, essentially styled along almost around the PCOB, requirements. you will find that their remit is not just to look at the the implementation of accounting and auditing standards, but their one of the focus areas is to look at even the financial reporting quality, apart from the auditing quality and implementation of auditing and the accounting standards as well. So CFOs over a period of time, I would say that will be also under very close scrutiny from the new regulatory authority, NFRA. So a major change, I would say, vis-a-vis what I have seen, maybe what I have seen over, say, last 2.5 decades.
So coming back to the reference of NFRA or NEFRA, or National Authority on the Financial Reporting. So what exactly is its role? What are the dangers the CFOs are going to face from this particular agency? We know how auditors have been dealt with by NEFRA. And the CFOs also are under the same kind of threat, the scrutiny, in the evolving scenario of the legislation surrounding the financial reporting.
So I think, so if you look at, I think, now just give a brief perspective. I mean, before 2018, or rather the NFRA came into being because of the Companies Act 2013. But it actually became effective from October 2018. And before that, the whole disciplinary, I mean, the self-regulation was with the Institute of Chartered Accountants of India. And then everybody thought that, I think and especially the regulators, and essentially you were also drawing strength or the references from what has also happened globally in terms of formation of PCOB, etc. NFRA was formed, which is National Financial Regulatory Authority, to essentially look at 4 functions. One is, implementation of accounting and auditing standards. Second is monitoring their compliance and oversee quality of professions associated with ensuring application of standards with an overall objective of public interest, investors and creditors, and effective oversight of accounting function as well as performed by the companies and auditing functions. So now I think this is very critical, that accounting functions performed by the company. So if you see, NFRA has been quite active, in last 4 years. I mean, I would say from 2019-20 onwards till to date. And they have issued number of reports. They have issued about 4 reports on the financial reporting quality, which is essentially they have examined the accounts of the companies and they have brought out the observations. Second is that they have issued about 7 reports on the auditing standards. Then there are about 13 penal consequences, which are predominantly on the firms and auditors who were associated with some of these companies where there were significant issues. And based on their observation, they have also come out with circulars which actually prescribe the accounting treatment in 1 or 2 cases, and so on and so forth. They have also come out with a kind of a discussion paper on whether the audit is required for the SME companies and so on and so forth. So they are very active, and many a times the references are, they are doing their own inspection, and the references are also made by, various agencies, including courts, etc., to look into some of these aspects which come under the purview of NFRA. And if you look at now the reports and the extent of details that they have gone into, and if I were to specifically talk about the reporting, I'm not talking about the audit part of it, is that they have looked at accounting standards, including Ind AS. They have looked at the application of policy. They have looked at whether the accounting policies and the implementation of policies, is there a contradiction. They have looked at some of the complex accounting issues, like, say, for example, Ind AS 109, which is a financial instrument. They have also looked at the ECL requirements. They have also looked at the adequacy of support and the documentation to support some of these impairment aspects, etc., etc. So what I'm saying is that not just the auditors review and their review of files, but whatever reports that they have issued for the on the financial accounts, I think they have been extremely thorough, and many of these reports are multiple pages, and they have essentially made a distinction between high impact, medium impact, low impact observations, and they have also given direction as to what should be done to implement some of their suggestions in terms of including restatement in one case. So I think they are becoming very, very active, and I see that this is only going to increase.
Okay, thank you. Kaliswaran and Raju, just be patient for a while, so I will come back to you. Before that, Anand, you are a thought leader in this area. You are associated closely with Institute of Chartered Accountants of India. You are associated with FRRB. So what are your thoughts on this? How what is the critical situation? What are the challenges CFOs are facing in the evolving scenario of these snooping agencies? And people were not so much worried about in the past about FRRB. But now with NEFRA being there around, everybody is so scared. So what has changed?
So firstly, I would like to thank ASA for giving me this opportunity to be part of this esteemed panel discussing such critical issues. Secondly, I would also like to start with a disclaimer that during my speech, I might get into some criticism of some of the regulators, but the intention is not to complain. The intention is that we move towards positivity and we bring out changes which would be helpful to industry at large and, of course, the country such. My perspective on NFRA is, everything has two sides, positive and negative. And of course, NFRA also has two sides. Let me start with the positive ones. If you see a history, largely institute used to govern only members, and it expressed that it has inability to increase the scope of its jurisdiction towards industry or anyone other than members of ACCI. And also, institute used to respond only on complaints received by it. It was not so much of a slow motor actions, but largely on complaints. Now we know that CA may not complain against another CA because like we say कि जिनके घर शीशे के होते हैं दूसरों पे पत्थर नहीं फेंकते. So largely you will not find too many CAs complaining about other CAs. And hence institutes mechanism was not so stringent or not so actively enacting on or taking actions on vendor and industry bodies. Now with NFRA taking some of the actions which we have seen over the last a year or so, it becomes all the more glaring that what we used to do over the last 50, 60 years compared to what is happening over the last couple of years. We can see that difference which NFRA has brought about. So I would give that credit to NFRA on picking up balance sheets, going through that in detail, finding out accounting standards or auditing non-compliances, bringing out to the attention of people, also coming up with circulars to ensure that we reduce the non-compliances. So I would give that to the credit of NFRA as well. Okay. So what has happened because of this? And it may not have happened as yet, but I have very strong hopes that it will definitely happen in years to come. It is the level of compliance, both from the auditors and from the CFOs, will go up significantly. Okay. NFRA has definitely started taking action from companies, and hence CFOs are now more sensitized towards compliance of accounting standards, towards disclosures, and auditors are also now more vigilant towards compliance of auditing standards, because every point NFRA has started checking the papers, auditing files, and assessing the work done based on the audit files and not on the basis of representations. So then they need objective evidence to justify the work done on the audit side and on the management side, both sides. And hence, it's not just the role of auditors now, but also the CFO and the management to ensure compliances. So I would say that, larger companies definitely, but even smaller companies should now pay more attention to compliances of accounting standards and all the laws, all the acts, whether it is related party, whether it is standards, whatever we talk about, because NFRA is not restricted to one law. They will check compliances of all the things applicable to a company. So a CFO now would be more, like I said, sensitive towards compliance with the law. So I will, like I said, these are the positives of NFRA. A couple of negatives would be, one of them for sure is NFRA has to mature over a period of time. So the observations that we have seen in the first few reports and some of the very basics also, like some basic disclosures, which most of the companies have not even seen, because those are not critical. For example, whether law allows you to revise your financial statements once issued. Now, practically, you would not find many companies actually revising their financial statements post issuance. So it was something, yes, a disclosure required, but it was purely compliance. It did not have much of substance. So such disclosures, I would not want NFRAs to bring up such disclosures, because these are not making any substantive additions to our reporting. Similarly, talking about, when we write this statement, you will find all financial statements that previous year figures have been reclassified wherever necessary. So NFRA commenting on such, I would want NFRA to mature more and come up with more critical, important observations of such, small minor observations. Lastly, I would want to make a point that there's an association of chartered accountants who have filed a case with Delhi High Court about the jurisdiction of NFRA on members of ICI. I don't know where it goes, but yes, it is something to watch out for. So that's it. Yeah, over to you. Thank you.
Thank you, Anand. So we'll come back more for this discussion if we are left with the time. Now we'll come to Rajiv and Kaleshwaran. See, the external financial reporting is at least structured. You know what you have to report. And of course, there are dangers, and you can be caught somewhere, and the reputation can be damaged if the work is not of the quality. But another dimension of the financial reporting is internal financial reporting. That is substantive, in fact, where you have to provide the information for the decision making, and you have investors to cater to. You have to provide the information to investors. You have to provide information to the management. You have to provide information to various other departments internally. And there are plethora of this. This is constantly evolving. It is unstructured. It depends on your innovation, how you provide, what kind of decision making you can support internally. And how are you meeting these expectations of various stakeholders, whether it is your various departments, it could be marketing, it could be production, it could be your managing director, it could be the audit committee, it could be the investors. What kind of innovations are you making? So from structured external reporting to unstructured world of financial reporting, and how are you dealing with this kind of unstructured world? And how are you satisfying your customers? What are you doing? So either of you can take up this question, but perhaps Rajiv, you can take it.
Sure. Thank you, and good evening, everyone. I hope I'm audible.
Yeah, you're audible.
You know, you actually took me back in time because about 35 years ago, when I started pursuing CA, and I still remember my conversation. I'm just giving a backdrop before I come to this answer. And I asked someone, listen, I'm pursuing CA. What's my future? Well, eventually you'll become a CFO. I said, what is expected of a CFO? And he gave me the best answer I could have ever expected. He said, you know, CFO, the answer is C, F, and O. So I said, could you please elaborate on that? He said, this is 35 years ago. He said, C stands for compliance. I said, okay, understand. So a CFO has to be compliant. Very good. F stands for functional knowledge. So you need to have a domain expertise on accounting, tax, law, etc. I said, understood. And O, I said, what is O for? He said, O stands for optimization. So resources are always constrained. You're always constrained by resources. So you always need to optimize resources. So that's C, F, and O, compliance, functional knowledge, and optimization. Now coming to the question that you asked. In today's day and age, I believe that the role of the CFO has evolved, but the definition can still be explained by this acronym C, F, and O. And this is how it would be. So when I talk about C, it talks about curated communication and collaboration. And this is where you deal with multiple stakeholders. And I will come to that in a bit. So C stands for curated communication and collaboration. What is F? Functional knowledge is definitely there, which was there 35 years ago. But today's F also stands because a CFO also has a fiduciary position. So the F stands for fiduciary, which is a position of trust. And the O here goes into objectivity, which means no bias and no favoritism. Now, to answer that question that you just raised, the C part I said is curated communication. Now, many a times I've seen CFOs talking only the language that they are best aware of, which is the language of numbers. But that's the language which only finance guys understand. But if you have to engage with different stakeholders, you need to speak the language that they best understand. And you also need to have a filter on what you need to communicate and what you don't need to communicate, because different audience, you have to communicate differently. So I follow a very simple policy that as far as the communication goes, obviously, you have to be collaborative. You have to deal with way more number of stakeholders than what we had to do maybe 20, 30 years ago. So when it comes to the management, I always believe in the power of graphics. And I always believe that it is important to go macro. So for me, communication, it has three parts. The first is communication on the performance. I always believe you start with the macro, start with graphics, start with direction, and then go down rather than crowding your slides and your presentations with too many numbers. So it's basically macro. The second thing is when it comes to risk, that's again something which we all have to deal with as CFOs. And that's something which our boards, analysts, investors, everyone wants to understand how we are grappling with risks. In my mind, every lock has a key, every problem has a solution, every risk has a mitigant. But every risk is not same, or it doesn't have the same level. So what we do is we grade the risks into high, medium, low. And accordingly, the focus is on high risks. That is extremely important. So our focus is on high risk. And how do we mitigate it? We also mitigate it by having the compliances or the mitigants also rated as high, medium, and low. So if it is a high risk and a high mitigant, and if they don't follow, then the score is 0. But if they follow, the score is 16. So if some combination does have a low score, then that's clearly an area of concern. So identify areas for exception and do an exception reporting and exception intervention, because you have too many things to do, so you need to prioritize your time. So as far as risk is concerned, have a framework through this identification of risk is identification of mitigation by grading the risk, grading the mitigation, and looking at the product to see which are the risks that really merits your attention. That's on the risk framework. Talking about thereafter the investors, analysts, and so on and so forth. Broadly, my experience has been that the communication that has to go to them is also governed by a lot of regulatory framework. For example, no forward-looking statements and so on and so forth. So we clearly need to be within that norm. Having said that, in my view, one thing I've always learned in life, that if you speak this truth, you have very little to say. So high level, macro, have a good risk framework, speak only what the other person wants to know, and don't crowd it with numbers. And I believe that if you follow this, you can deal with different stakeholders, whether it's the board, whether it's the analyst, whether it's the investor, or whichever stakeholder that you deal with. And it's very important. I've seen that when you especially deal with operations or the business folks or the HR, you cannot speak the language of accounts. You need to speak a language which they can relate to. And I've always seen over a period of time, when you start speaking the language which they can relate to, the response and the receptive and the way you are received and the response is way different from what you would do so when you're speaking with another finance colleague. And in terms of, again, the other thing is that when it comes to the regulatory authorities, very often we tend to filter. Many people tend to filter the communication. But my experience has always been go up, speak up. And I've always found that the authorities are also backed by people on the other side of the table. And when they see that you're being truthful, you're being forthcoming, the reaction towards us is also very, very different. So I think it's very important that your communication should be truth, fair, transparent. And I think that's the way we have always been.
Thank you, Rajiv. So, Kalistran, so you have 2 decades of rigorous CFO experience. So, how you have been able to satisfy your internal customers with this dimension of the financial reporting? So, what are the innovations that you have seen over a period of time, and how are you can bring the technology dimension also here? How are you using the technology to innovate, to deliver the information just in time basis so that there's no delay for the decision making? So decision making is very, very important. The right time decision making is very important. How this internal financial information is helping the decision making, and how are you achieving innovation in this using the technology?
Thank you for the opportunity to ASA. Sorry, my voice might be a little feeble. I'm just recovering from a viral. Pardon me for that. And Rajiv actually very well covered around the framework of how do you drive the internal reporting communications. And if you're looking at tools, probably the way I would start is fundamentally, there's a nice book that was written by John Doerr called as Measure What Matters. In many organizations, you tend to boil the ocean. And you tend to also go behind fancy stuff. There are tools available in the market, there are softwares available in the market, and then you tend to go and pile up things without understanding where the organization stands. So to me, the starting point is to understand where does the organization stand, what is the journey it wants to take, and what's its 3-year, 5-year vision that it stands for. Now, this is articulated by the management, vision approved by the board, and then the leadership team takes accountability for owning that. To make this come to life, you need to have a control tower. And that control tower, I think finance is probably best positioned to do that and anchor it across all the verticals of the business. It starts from how do you deploy your goals? How do you ensure that there are cross-functional sign-off that happens on goals? The interdependencies are clearly aligned. And you have the innovations and tools. I would like to keep it very, very simple ones. Like, do you have a smart code? Typically, people would love to say that as to, I want to grow sales. Okay, that's a great, fair intention. Absolutely fantastic. Thumbs up for that. But then can we put across by saying by what percentage, by which region, by how many products you're going to launch? What is the ad campaign going to be? How are you going to measure the effectiveness of ad campaign? So how do you try to make these smart? So which is specific, measurable, achievable, realistic, and time bound. That's a starting point. Second is to look at what is the IT platform that you're operating on today. Yes, I think when you're operating on an ERP or a non-ERP, you can go up to something like an ANA-plan for reporting. But have we leveraged our existing, say for example, an ERP to its fullest? Today, if you take SAP as an example, the facility that SAP can do is commendable. We can have a warehouse management system in SAP. SAP can throw out a clear BI. Your entire financial reporting can be done through SAP at a business unit level. It need not be only a statutory financial reporting that you need to have. So have we first leveraged the existing systems and processes that we have to ensure that the reporting is at the level at which we need? Second, the third point is don't be fixated and constant. Please be dynamic to understand that business needs are evolving. Many a times when people come to finance, the mindset is that, hey, I don't get a solution. I only get a rule book answer why it can't be done. But the moment you start putting yourself across by saying as to, hey, there is a genuine need for business to come back and say, I need to create, say, a new business division or a cost center or a profit center in SAP, which can help them to declutter and also understand the business in a much better manner. So how do we facilitate those conversations and how do we get going about it? That's a third thing that probably I would love finance folks to go and look at it. Fourth is having a simple ecosystem of periodic monthly review to understand how you are progressing. Many companies do it in many different ways, but in my view, these needs to be very specific and objective. We tend to go all around the place in a review without understanding the purpose of review. We need to be in a financial review. You cannot go and review a success of a marketing campaign, and in a marketing campaign review, you cannot go and see what's a succession plan that you're doing for people. In many meetings, we tend to have not very specifically clear objectives defined, and you tend to not have productive discussions. So one, the great PowerPoint, I think as much as a tool it can be, it can also be a detractor. So can we ensure that we don't present more than 10 slides for any discussion? And can we stick to the agenda that we have on what is that we want to achieve in that? And how do you evaluate the progress? Finally, 80% of finance business reviews are spent on what has happened, and only 20% is focused on what will happen. That's a big derailer. That's a big derailer. It's an unproductive time. You cannot change what has happened. You need to only start thinking, how can I get better from here? So in that sense, I would urge people to start spending only 30% of time or less than that for what has happened in a business of the previous month. Spend more time on forecasting. There are enough tools available to do that. Forecast for the month, forecast for the quarter. That's when true impact can be made and you'll be able to change the needle. And all this together, if you can talk the business language and drive it, I think internal reporting can really move in like a magic day for me.
Thank you, Kalisri. Yeah, Sunil, coming back to you. So auditors are not just auditors for in Indian context, they are also consultants in a way to the CFOs. The CFOs learn a lot from the auditors in the interaction, because auditors, you see several clients, whereas the CFOs would have seen only 3 or 4 or 5 companies in their career. And we draw a lot of expertise from auditors. And how do you, phrasing? Are you able to hear me? Yeah.
Yeah.
So Rajni, my question. How CFOs can collaborate with auditors, learn from the auditors on particularly the external financial reporting, and to avoid the kind of dangers that lie ahead, particularly in the evolving legislative scenario. What is that they can do? How this collaboration work? Maybe you can give some tips to the CFOs. This is the way you can collaborate. This is the way you can take advantage of our expertise, experience, and a wider base of knowledge. So if they are hesitant to approach the auditors for in the consultant role, perhaps they should start doing it and take expertise and advice from the auditors. How do you think they should collaborate with you?
So, Mr. Subbarao, I think the critical success factor to ensure timely and good quality financial reporting, I think depends critically on collaboration between CFOs, auditors, and then obviously in turn with the audit committees. And I think one of the critical things, I think, which I would say is that I think both these the CFOs and the auditors can actually work in tandem in such a way that you ultimately achieve the objective in a timely manner and to ensure that it's a quality financial reporting. So I think one of the key aspects is for the CFO and the entire finance function to recognize that maybe I'm talking a little theory, that the ultimate responsibility for the preparation of the financial statements is with the management. But while doing that, what is also important from a CFO's perspective is to create that kind of an environment, that kind of a tone from the top, that the company will implement either the accounting or the internal control procedures, and you will essentially do what is right. So that's the first and foremost. Make sure that the company proactively puts the entire risk management and the internal control mechanism to ensure, especially on the internal financial control, to ensure that the financial information which is generated out of the systems is robust and has the quality output. That's the second. The third aspect, I think, which is very important, is to proactively engage. And here auditors also have to take a step forward to say that in the entire audit planning process, if a CFO and auditors can collaborate, that can actually make a world difference. Okay, in terms of either the timing of the audit, what is going to be the auditor's approach, what is the methodologies that they are going to put in place, whether they will conduct interim audit, whether they will conduct when they will be testing the internal controls, financial controls, what will be their approach towards some of the estimation and judgmental areas. All these aspects, I think, if these two CFOs and the auditors can discuss well in advance at the stage of planning, I think it really goes a long way. And this has been my practical experience. It really goes in a long way to make sure, because what audit committees typically do hate is the surprises at the end. Okay, so nobody wants surprises at the end. So how do I achieve, no surprises approach, or at least mitigate that, in the financial reporting process? And I think one of the critical factors will be for the CFOs and the auditors to collaborate. So I think it will be very important even for the CFOs at the start of the audit, maybe give a kind of a quick overview and presentation on what has changed, what are the typical new risks we are talking about, are there any challenges in terms of any investment decisions which have been made, is there any rethink on that? Is there any rethink on the way, I think, some of the accounting policies are being implemented, etc., etc. You can actually, deal with this very proactively with the auditors. The second part is that I think, which is very important and which I have seen in some of these global companies do very, very frequently, is that for any complex issue, whether it is accounting, auditing, or anything to do with even the regulations where auditors can give their own perspective, what the companies will typically do is that they will prepare a discussion paper, on the aspects, the critical aspects, the new aspects which are facing them in a particular financial year, and then seek auditors' views thereon before they are implemented. So what happens is that you essentially avoid discussions at a later stage, okay, which again, can bring some nasty surprises when you're finalizing the account. So I think in this way, I think the CFOs and the auditors can collaborate. The other aspect is that when you are actually communicating to the audit committee, CFOs can essentially work on scheduling audit committee discussions, having maybe pre-audit committee calls and pre-audit committee discussions to make sure that some of the critical matters are thrashed well in advance before the final audit committee or the formal audit committee takes place, to ensure that again there are no such decisions actually which can derail the smooth functioning of the audit committee. So there are a number of these things, I think, which the CFOs can do and which the auditors can do from their perspective in terms of timely intervention, timely bringing out the issues for the attention of the CFO, audit committee, etc. How they intend to deal with, are there any kind of showstoppers, are there any kind of issues which may find its way into the audit report? Are there any aspects, I think, which the companies can mitigate, to ensure that there are no such surprises or no such unpleasant things appear in the audit report, etc. Can really go a long way, in achieving this, and especially in these circumstances, and especially in this environment where the changes are so frequent. I mean, recently, for example, you had all these, maintenance of audit trail, and there was a notification in August 22 that you have to have a daily backup. Now, people were really struggling to figure out as to how do we deal with this particular situation. Now, here, I think, from the CFOs or the finance functions perspective, to identify such are the issues which are going to affect my company and how do I deal with that, and then deal with auditors proactively, because ultimately they also have a reporting requirement on these matters, to say that what is their point of view, okay, while finalizing the accounts. I think this kind of a collaborative approach will really go a long way. And I think in quite a number of cases, what I have seen is that some of these critical matters actually are dealt with at such a late stage that it becomes a kind of a heartburn issue as well, with the audit committee, with the CFOs, and with the auditors. So I think, you can avoid that, and you can really make the relationship great. I mean, if you take some of these steps.
Hope artists don't charge for this collaborative time.
Yeah, absolutely. And especially in today's circumstances, there's so many changes. I mean, India is undergoes substantial changes. There are disclosure requirements. Now, SEBI is bringing out all these BRSR, and now there is a BRSR core, and they may now talk about giving assurance on the limited assurance on some of those aspects. I mean, you have plethora of things now. Even when you are giving an assurance on these sustainability reporting, for example, I think you will need to deal with the auditors proactively, because this is going to come in 2024-25, for example, if it goes through. Then you might as well start discussing with the auditors as to what should be done, how do we go about it. So I think this is just one or two examples which I'm talking about, but this is how it goes along with achieving objectives.
Thank you, Sunil. Thank you for all the inputs. So Anand, being part of the regulators, I would request him whatever best he can scare us, he can scare. Rajiv, my next approach to you is, in the evolving legislation, Sunil has just mentioned some of the latest audit trail, data backup, all these things. Daily something or the other is coming up from the various legislative corners. So, given this kind of evolving scenario, how do you think that the CFO should cope up with this kind of situation, and what lies ahead? Is it the end, or as the economy keeps growing like this, and more of international happens, and more of integration with the international world happens, are we going to face more and more of this rigorous legislation? And this is the way of life for the CFO. This is how they have to keep going. So they have to pull up their sleeves and keep learning. What lies ahead?
Yeah. So, see, firstly, I have spoken to quite a few regulators about the number of compliances that are going up significantly. On one side, we talk about ease of doing business. On another side, we are increasing the compliances, and all these compliances definitely have some significant cost. For example, the RPT laws which SEBI has brought in. I have seen large companies allocating a resource, full-time resource, only on ensuring that RPT compliances are done properly. And when we represent such things to regulators that the cost of compliances are going up, the response that if I have received is cost of compliance is no reason to not ask for such disclosures. So if there are any other practical issues, we can go to them, but they do not believe that cost of compliance should be a reason regulators would worry about. Effectively saying that if you are a listed company, if you are a large company, should be ready to spend ensure compliance because you're getting investors' money. So investors' disclosures have to be taken care of by the company, irrespective of the costs. One is that. Second is, I can take an example of RPT again to give a snapshot about how should companies ensure such compliances. Say, for example, like I said, related party. Now, definition of a related party as per Companies Act is slightly different from that as per India. So, one company needs to ensure that it is rightly identifying all the related parties. Second is transaction. Currently, the identification of a transaction with related parties is largely done manually by most of the companies, even including quite a few large companies. When I say manually, I mean going to the ledger, going to the books of accounts, but it is not a system where the systems tell you that this is a related party transaction which you need to report. There are no such systems today, at least. There are ways of doing it which are difficult, which are not 100% there. For example, in SAP, you can identify a related party, and every transaction that you do with related party, you can get a report of those transactions. So you need to tag that party as a related party. Okay. But that also does not ensure all the transactions are taken care of. That also does not ensure all the compliances relating to RPT is taken care of, because the way SEBI has done it now, they are saying that even if it is indirectly benefiting a related party, not directly, indirectly benefiting a related party, you have to consider it as related party transaction for the purposes of compliances, for the purposes of reporting. So practically it is related party transaction. Am I audible?
Yes. Yeah, you're.
Yeah. Okay. So point is that it's not a system-driven process anymore. It's not that that systems can identify. So companies need to have resources allocated. Companies need to work upon how they can ensure compliances. So that is something which is very, very critical, and there is no way out as of now. There is no system which can do it. So you may have to put more resources. Another example which mentioned was daily backup. Okay, now daily backup of how many days? Currently, the way systems work is every 30 days, on 31st day, it will replace the first day's backup. 32nd day, it will replace the second day's backup. So it's a cycle. So you would have 30 days backup. You would not have 365 days backup. You would not have, say, a 720-day backup. You would not have those. Currently, the systems which corporates use are not geared up for that. So, a lot of cost would be involved in ensuring such compliances. And I strongly believe that regulators need to relook at this point. They cannot be closing their eyes onto cost of compliances. They need to definitely look at what is driving the benefit and what is the cost of ensuring that benefit. Back to you.
So, thank you, Anand. So, Kale's friend Rajiv, coming back to you again. See, the character of the company is more important than anything else. It is the governance, which is nothing but the character of the company. So that adds to the reliability of the financial reporting, externally at least. That's what we know. So well-governed companies have a better image because people don't look into their financial reporting much because they take it for granted that things would be right. And those, whether the smell easily spreads, whether a company is well-governed or not governed, so it easily spreads. One of the important tools of governance, as far as the financial reporting is concerned, is the audit committee. And how you deal with the audit committees, how you satisfy with audit committees, how do you give an image of well-governed audit committee process? Because a lot depends upon the CFO apart from the audit committee members. So what do you do? Do you have a say in the selection of the audit committee members when you deal with your promoters or management? And because it's the quality of the audit committee members also that decides the governance and also the image of the audit committee. So these aspects, first, whether you have any say in in selecting the, at least giving your voice to the selection of the audit committee members and how you deal with them, because ultimately you have to go and face the street as far as the reliability of financial reporting is concerned. So audit committee is very, very critical tool in lending that reliability to the financial reporting. What are your thoughts? What are your experiences in this? Yeah, Kaliswaran, maybe you can.
Yeah, sure. I think fundamentally, I'll also start with some of the previous conversations that we have been having. To start with, I think thanks to our Prime Minister's leadership, we just had a fantastic G20, and that has taken this country's position multiple notch up in the global world. The amount of money that has been coming from FIIs is unprecedented and historic, and this is only continue to go up as we look at the future. So I think we need to start embrace the changes that is going to come in our way, and it is only going to get increased because we cannot afford any other event that can dilute the image of the country at the global stage today, where we are. And today we are a country of, it's not only more about a country of power or economy, it's a country of say. In that position, you will see, therefore, from a regulatory perspective, things will only get stringent. And probably it's time that we embrace it and we accept that it's part of our day-to-day, have the right system, process, people organize towards it and get it doing. Otherwise, I think we might be also fighting a battle on something that we may not be able to change. That's at one end of it. Now, coming into the audit committee, first and foremost, I think we are a board-run company. We are one of the very few organizations in India which is board-run and employee-managed. We have a very, very reputed independent board and probably one of the best audit chairs that you could ever ask for. So from that perspective, I think we tend to learn a lot from our audit committee and board in terms of what is that we need to take as our disclosure requirements. And eventually we see all ourselves as having a significant fiduciary responsibility, and that is pretty much simple, comes to total shareholder value creation. So let it be the management, let it be the board, the existential of the organization is only for that. If you have to call out something as the corporate dharma for our existence, it is to create shareholder value. Now, if you put that at the center of it, in terms of what is that you're trying to solve for, and what is that board or an audit committee may seek, it is all goes back to the interest of investors that they are seeking for, and what kind of clarity that you need to provide to them. So there are two parts to it. One, the CFO will also act as the chief trust officer, which is to ensure that all the stuff that gets into your financial reporting are right and reliable, with the level of assurance that you need to get on various stuff that you have to get. The second one is probably where it is pretty much undersold in India and underskilled also to an extent, is the art of storytelling. I think finance and storytelling probably is seen as a very, very unrelated art, but I do believe a good CFO needs to be a good storyteller also. Eventually, your company is a story. Your company's value creation is a story. Your company's purpose is a story. And that needs to be heard through by various stakeholders, and you need to align them on the same page. Now, when it comes to that, that's when you start using tools within the financial reporting, things like integrated reporting. You don't wait for a SEBI to come out and say that, hey, now you've become mandatory to do an integrated reporting. You go voluntarily and get an integrated reporting done. And you don't stop with that just by doing an integrated reporting. You believe it's good for you to get the assurance done on the integrated reporting also. So you get it assured, so it provides even more reliance for the stakeholders to review it. And sustainability is no more a good thing to have. It is probably becoming must from a global perspective. And second, it can also be a very interesting competitive advantage for organization, right? So for a company like us who deals with energy 24/7, sustainability is probably embedded into our ways of working. Now, how do we bring this to the forefront of our communication? How do we ensure that as to our ecosystem understands that as to we have methodology in which our entire advantage sustainability is clearly called out and we have actions in pipeline. Fundamentally, what is that somebody wants to understand? If I have to put money into the company, I just need to know that the bases are good, there are no risks involved in running of the company, that's taken care by an assurance. A good auditor certification from a good backing takes care of that. More importantly, once that, probably I would call that as price of entry into a stock. The decision is made when you know that the company has got good growth potential. Is the company has got good amount of profitability expansion that's there? What kind of cash distribution policy the company will have? And is the company willing to take risk? And therefore, is there right capital allocation policy available to nurture that risk-taking ability that we want to have over a period of time? Now, this part is something is very, very under-communicated in our entire financial reporting today. I would nudge one from a regulatory perspective. We do relook at this and see as to how much of this can be addressed in. So it more and more move towards forward-looking financial reporting. And typically, if you get an annual report at August of the following year for the previous year, and if that's going to be reviewed in September, there's only so much of limited information that you can get in from there, even if it is regulated to the T by various authorities. So we need to move a little bit more forward on this. We need to ensure that every stakeholder gets benefited and looks forward to an annual report, or why not a half-yearly report, whatever that we think is right, which is meaningful for the stakeholders to engage, and therefore they know in a regulated environment where it is not possible for you to share everything with the investor. This can act as a great confidence builder and can attract multiple investors to come from various backgrounds. And once you solve for this kind of stuff, I would believe that it's a delight for an audit committee or a board from that perspective to support the organization in its journey and how does it want to move forward. Sorry, slightly a different answer. I thought it's important to set that context.
Thank you. Rajiv, so what are your thoughts as to how you can drive internal corporate governance, particularly audit committee governance, to lend greater credibility to your financial reporting, external financial reporting particularly?
Thank you. I think Kaleshwar has beautifully summarized it. Now I'm trying to look for points. But okay, there are a couple of points which I definitely want to top up. The first point is that I'm just going to give a context and then come to the response. That recently we were on a roadshow, and these roadshows were all out of the country. I am talking about Singapore, Hong Kong, New York, Boston, and London. In those 60 minutes of conversation with the fund houses, almost 7 to 8 minutes of the conversation was on how are you managing your corporate governance, which basically goes on to show that how corporate governance is being seen by your investors and stakeholders.
Yes.
That's something which is, I was very impressed with the fact that in 60 minutes they could have asked us about more about our performance, more about our strategy. They did ask us all those things, but almost 7 to 8 minutes on an average was spent on corporate governance. That's one. More importantly, I've been also attending audit committees, which have been chaired by some of the finest professionals in the country. To name a few, Mr. Deepak Parekh, Mr. Dadi Seth, and so on, and similar vintage. Now, one thing I have always seen is that the audit committee chair is a very important position, and that really sets the tone of the meeting. Now, the audit committee meeting could possibly be there for only half an hour, possibly 1 hour at best, really, in mostly. Now, in 1 hour, how much can you discuss? So, which is what is very important is how are the channels of communication open outside of the audit committee, which is called a pre-audit committee, or otherwise other conversations, how accessible is an audit committee chair? If you as a CFO or if you as a senior management member have to reach out. I have always seen that our audit committees that I have been a part of have never been driven by a fear. I've never been driven by fear. So you're not concerned, like you're not concerned, it's not the right word. You're not bogged down into saying the truth, being transparent, being open. And you're not worried as to how the audit committee chair will consider. Because for the audit committee chair also, it's very important that the team, and especially the CFO, reaches out and confides. And that relationship is extremely important. And I have been fortunate that we have worked with audit committee chairs who have been extremely participative, been very good listeners, been very good guides, and have always guided you to in the right direction, despite sometimes being in very difficult positions and situations also. And I felt that behavior has actually led to higher corporate governance. That's one. The second thing was that we have also, just like Kaleshwar, we have also been in boards where it has been really board driven. Board was never just a rubber stamp for us. Board has always been very powerful. And the independent directors have been extremely powerful. When I say powerful, that means they carried the weight. But I've always seen that they have always kept a very macro outlook. But whenever you needed them, they did not hesitate to get into the as macro as you wanted them to. And that has actually, over a period of time, helped us and me individually to drive corporate governance. Because once you have that support, that really helps you to drive corporate governance. On the other hand, while that is one part of the corporate governance, you also have a responsibility to drive corporate governance at your end also. You just can't have conversations and not drive corporate governance. There again, we have always discussed risks in a very different way. Now, risk broadly, I'm just going to categorize into two parts. One is the statutory risks and one are basically the business risks. Statutory risk is what audit committee has always dwelled on. And business risk is always what the board has always dwelled on. When you talk about statutory risk, we've always had a clear-cut list of the macro risks that we always need to ensure that we are in compliance. That is one. The second thing is the composition of the board. Is the board heavily promoter-driven or is the board independent? That depends upon the count and that depends upon the composition. We have had boards which are fairly independent driven and fairly professional. That also helps you to ensure that when the decisions are being taken, there is corporate governance. Long story short, composition of board is very important. The communication and the channels of communication that the audit committee has with the senior leadership team outside of the audit committee meetings is very important to drive corporate governance. Corporate governance is here to stay. It's only going to increase. Whenever you're going to raise money, raise funds, deal with any stakeholders, they are insisting on corporate governance. And that's going to increase as we go along.
Thank you.
Thank you.
Yeah, please carry on. Sorry for it.
And one thing, I was a part of the very interesting program. There was a program, I don't want to give the details of the program, but it was led by one of a very celebrated board members, global board members. And he had flown down to India and to teach us some of the best practices as far as the audit committee is concerned. And as Kaleshwar also said that, one of the points he did mention was that how does the audit committee spend that 1 hour? And we realized that the 1 hour that we are spending was in a certain manner. And post that session, we started spending that 1 hour in a very different way, which made us more productive and clearly driven on forward-looking approach, more focused on corporate governance, rather than reading and reciting what we have already read, what was already there in the books. So all the presentations, all the documents that were supposed to be presented would already be circulated. Everyone was supposed to read and come, and the entire 1 hour, 1.5 hour was spent in a very interactive manner. And it was not just a question and answer. Even the people even the board members came with the suggestions. And those suggestions were very valuable for us to drive corporate governance.
Thank you. Yeah, so this is a topic which can go on for one day, whole day. I think all the things have to come to an end. I borrowed an additional time of about 15 to 25 minutes already from the management. I think we need to close it. One more question is left, but that is little outside the financial reporting. I'm just leaving it on the risk management. Anyway, Raju, you covered a little bit on the risk management, so I would leave that question out. So then we have to conclude this session. So thank you all for sharing your experiences and insights with the CFO community. Very precious, invaluable thoughts. And there is a thought leader. There is a tons of experience in the audit profession. Sunil has I learned a lot from him during my association with him as an auditor. And so Rajiv, I know him for a long time, so it's only college from who is little new, and Dr. Anand, of course, I heard about him in the past. So thank you all for sharing your insights, thoughts. Wish we have more time for going on this, and we will move on to the Q&A a little bit. There are a few questions that I have received before the start of the session, as well as one during the course of the session. We will deal with those things, and you can all whoever wants to take it up, you can take it up. The first question is on the startups, so which has come during the course of the. One second, let me open it. So what it says is the startups don't have the CFOs like companies have the CFOs. Even if they have perhaps the shared CFOs. And how do they deal with this evolving regulatory scenario? And because they also have to do the financial reporting, they also face the same dangers from the regulators. They also face the same snooping agencies all around them. So how do they deal with this? So perhaps Anand, you and Sunil are the right people who can answer this.
So maybe I'll quickly give my bit and then pass on the mic to Sunil. So what I've seen is over time, investors are pushing startups to have a CFO in place. There was a time where startups did not invest in having a CFO. And many startups failed, which we have seen over the last couple of years. But now, we have seen last 6 months or so, investors have started pushing in, a mandatory clause to have a CFO, or even we have seen that startups who do not have a CFO, many investors do not participate in those startups. So one, yes, startups also require a good CFO because Rajiv said that, the responsibility of CFO is very wide. It's not just clients. And that is how a CFO can participate and make sure that startups succeed, at least on the financial side. Okay. So things are changing, I would say. It's not that startups do not have CFO. I have seen last, like I said, few months or a year or so, startups have started going back to CFOs.
So I think I agree with Dr. Anand.
Yeah, please go on.
So I agree with Dr. Anand, considering that there has been now such a significant change in terms of the reporting and the regulatory requirement, that it is imperative that you have to have you may not have a large finance function basically from a cost perspective, and especially I'm talking about those startup companies which are in the initial stages of their growth. But you definitely need somebody, I think, who will coordinate this entire effort, who possibly could be involved in terms of outsourcing some of these routine functions like a accounting function or a secretarial function or the compliance function, etc., etc. But a promoter who will be essentially, or the group of promoters, I think, who will be essentially concentrating on the businesses and the growth of businesses, you will need somebody, I think, who takes care of the compliance side. And many a times I have I observed that in startups, I think this particular aspect was not given proper attention to, but I would say that it will be at a very significant cost to the company, not in terms of penal consequences, but even from the brand erosion perspective. So I think it is very important that we take care of this matter.
Thank you. So now we would open the forum for the Q&A from the questions from the participants. Any questions from the participants? Okay, there are some questions which we received before the start of the session. The first question, how do we improve the financial controls? Perhaps I would add, is there any technology that we can add to this to improve the financial controls to automate it? Particularly the whether we can borrow anything from AI. And recently I read somewhere that FRRB is planning to use the AI to detect the inadequacies in the financial reporting. So maybe Dr. Anand can answer this. Similarly, are there any tools which we can use and automate the financial controls to strengthen them?
No, so I would, because this is more of technology based, I would leave the question to other panelists, which we have like Rajiv, and they have already discussed technology in their questions. I would send the mic to them for this.
Okay. Rajiv or Kalesh, any of you want to take up this?
Well, the question was on the tools. So see, as far as the transactional piece of the finance is concerned, I think it's widely understood that there are lots of tools. There have been BI tools, but these BI tools have certain limitations because they are always they have some limitations. Of late, we are actually exploring some AI options. It's too premature for me to kind of tell you how they will shape up, but I can tell you one thing for sure. The AI is very intuitive. So for example, you have a base data and these are not expensive. In fact, last week only I had a demo. I'm looking at a few more products before we conclude. So the answer is that, see, as far as the structure is concerned, procure to pay is concerned, there are a whole lot of softwares that are available, a whole lot of platforms that are available, whether you look at Oracle, whether you look at SAP, PeopleSoft, and so on and so forth. They all give you procure to pay the entire transaction, which gets automated. Then you can have BI tools. For example, I've worked with Hyperion and so on and so forth. So which kind of acts as a BI tool over and above your accounting software or your ERP to give you all kind of MIS reports. But these MIS reports to a large extent is predefined. But the kind of environment that we are heading into, where you have a set of database and you could ask any question. For example, when you ask a question to Alexa, it's not predefined, right? So that kind of AI is what you need for your organizational data. And what I've seen is that I've seen tools which are there, not very comprehensive as yet. So for example, they can work on a database, cull out certain reports, certain graphs, etc. But when you are expecting them to drill down beyond a point, it is not possible. So a BI tool like a Hyperion or something is still possible because you have pre-fixed it. You have set the path. So they can do it. So if you have not anticipated, and then you are trying to ask a query which is out of the box, then there are limitations today in the tools that are available as far as the AI tools are concerned to drill beyond the point, because the data, the architecture in all the companies is not aligned. They are not alike. And this today, a lot of this AI is still contingent on or dependent upon how your database is structured or how your architecture is organized. And since two organizations' accounting database architecture is not similar, AIs today have a limitation. They have not evolved to a level where they can be very intuitive. But the direction I see them heading towards is that they are going to get very intuitive. So not only the transactional part of the business is going to get automated, even the querying part, which is not anticipated earlier, is also going to get very intuitive. That basically means that all finance guys will have to reskill themselves.
Just to add to what Rajiv said, see, fundamentally, it starts with structure. For a medium or a large scale organization, it might be better, what I call it as a second line of defense between your auditors and the transactional users is the internal audit function, which could be an inbuilt internal audit function that you create. And I would also request people to look at this from the perspective of not having only CAs. Can you have some engineers and sales guys under the internal audit function who will be able to get into the business processes and understand where are the gaps and how can they pull that out? One. Two, I think from a structure perspective, we have this entire IFC playbook that's available, where you can have continuous control monitoring tools that can be put in SAP. I think you have almost 600 plus controls that can be automated, which can proactively tell you what control breach has happened. And if you think that is not possible everywhere, have something called as a continuous self-assessment of controls, where every function where the control ownership is defined at the transaction level, the transactional user can on a periodic basis declare whether the control check has been performed, whether it has violated, not violated, etc. How do you do it, and then take it up. And then you have a monthly review mechanism to see how much of this is red, amber, green, and improve it over a period of time. As far as other tools are concerned, you have things like contract management system that helps you to manage the entire contract life cycle to ensure what are the terms of the contract, are you in line, not in line. There are tools like Legatrix available to ensure that legal compliances are taken care and you ensure that that's on an ongoing basis is pretty much there. And then you have the AI tools available, even if you have to go on do some kind of a forensic. How can you quickly run a fuzzy logic? And the fuzzy logic can throw out what are the outliers that you have for each of the transactions or area that you wanted to review, and what outcomes that can take that forward. So first is have a vertical setup with finance and non-finance people. Leverage ERP to put continuous control monitoring and self-assessment in place. And then you look at tools on each of these things on a customized manner for various areas like legal compliance or contract management or for a forensic audit.
Thank you. We don't know the potential of AI. Maybe one day we will have all accounting policies AI will dictate, saying that this is it will take what is available from the accounting standards and say that these are your accounting policies. They can analyze your accounting policies and tell you that these are the mistakes in your accounting policies. And they can prepare MDA and A, they can do the entire financial reporting, they can prepare the business responsibility and sustainability report. So you don't know. So today, ChatGPT is preparing one report if you want it. So they are able to take the information. We don't know where this devil is going to take us. Whether the devil or divine, we don't know yet. So, but its potential is amazing. So fathomless. So we will get to know as we go along. Maybe I don't know whether I would live up to see the explosive potential of this artificial intelligence. So let us conclude this. Thank you all. Thank you so much for your insights and experiences that you shared with this. And for the CFO community, I think the past, like mutual fund statements, we have to make the statements. The future is not going to be like past. There is no guarantee that the future is going to be like the past. So with the plethora of the regulations that are coming in, we don't know what is. One of the regulations now that have just come in a couple of months back, if there is any media rumor anywhere in the world reported in the mainstream media, so the CFO has to report within 24 hours to the stock exchanges. So only AI can do that. Nobody else can do this. So it is impossible to capture whatever is published anywhere in the world. We have seen what has happened in the Hindenburg. So this is just the beginning of this. So we have to. So AI will replace CFOs one day. We'll see. So then future, the only caution to the CFOs, the future is not going to be like past, and the CFOs have to become better leaders, better technocrats. They have to be more vigilant. So far they have been dependent on the company secretaries for the legislative inputs, but they cannot afford to do it any longer. They have to be on their own feet. They have to learn. They have to be constantly vigilant as to what is happening in the external environment. They have to become better leaders, and this is what the path that lies ahead for the CFOs. So that's all that I have to say. So I will hand over the session to Vikram. So thank you for this opportunity. Thank you for ASA for this giving me this opportunity. After my retirement in the last 2 years, this is the first webinar I'm attending. So thank you all.
Thank you.
Thank you so much, Mr. Subbarao, for being such an excellent moderator, and a big thank you to Rajiv, Kaliswar, and Anand and Sunil for leading us through this very engaging session. And it was definitely a very pertinent hot topic, I would say. Thank you to our amazing audience too for this patient listening. We've overshot, I know, but yes, I'm sure everyone would have benefited from this beautiful interactions which we had with this esteemed panel. We will also be sending a summary, emailing a summary of the deliberations and a link with the recording to all the participants. We've tried to answer as many questions as possible, but feel free to send your further queries, and the unanswered ones would also be responded over on email. Once again, thank you all for joining us today. Have a great week ahead. Thank you so much.
Thank you. Thank you.
Thank you, everyone.
Thank you all. Thank you for the chair.